Hey traders, welcome to Charts and Coffee FOMC edition. We've got Powell and company on tap for today, and that means we are going to get some clarity on not whether or not we're going to see rate hikes. Stick a fork in it, that's a done deal. The bigger question is, to the degree that we know there's either a half point or a 3/4 point hike coming. And a lot of folks have asked me, Rog, what's the difference between getting those two different hikes? And I talked about that yesterday in the free video over at the Simpler Trading YouTube channel. So if you get a moment before 2 p.m., go catch that. Two setups for the FOMC. But in a nutshell, even if we get a 3/4 point hike, I am not looking for just this dismantling of the equity markets. In fact, what I'll be keeping an eye out for is essentially whether or not we get a half point hike. And a half point hike could trigger a fairly significant rip higher. Now, this rip, in the context of the trends that we have now on the indices and in the sectors, these would be retracements. These would be a sell the rip opportunity. So this is not a bottoming conversation that we're having in a double red downtrend. This is more about, if we move higher, at what point, at what height of the retracement can we start looking long puts? And especially when it comes to NASDAQ and NASDAQ related sectors, XLK, XLC, XLY. So that's where the focus will be for a half point hike. Frankly, we might even see a rip higher for 3/4. If we see the 3/4 hike, and chances are that's what we're going to see. Again, the expectation for movement higher for me is pretty much intact regardless. But what gets interesting is the press conference and the statement itself. In other words, if we get the 3/4 point hike, what we're then looking for is the tone in the press conference, and we're going to watch the Fed fund futures. That graph that I walk you all through in the free video that I just shared with you, it's over at the very channel you're at right now, likely the Simpler Trading YouTube channel. It's the free futures video from yesterday. We want to see the way in which those start to realign towards what we're going to see in July, what we're going to see in September. We're going to continue to see hikes, but at what pace, right? That's the game that's being played today. I'm not just overtly bullish, but the expectation for a sigh of relief rally, because generally speaking, the 3/4 point hike is quote unquote priced in. And so there's not a shock to that, right? What would be a shock? A full point hike, right? And I'm not talking about anything like that, but that's the game that's being played today. All right. So as always, gang, this show is about your questions. So let's go ahead and jump into those right now. And, before I get too ahead of myself, and I am super stoked about this, not only because, this environment's been a little trying, obviously, but the way that I've been navigating this market is not necessarily being overly concerned about what's going to happen session after session or week after week. That's just not the clarity that we have in this very will they or won't they in terms of monetary policy environment. So one of the best things we're doing is shortening the time frame. Instead of looking at windows of days to weeks, we're looking at windows of hours, really. And that is what day trading is all about. Shortening the time frame, shortening that time horizon window, so you don't need that session after session continuation. Tomorrow, this is happening tomorrow. A lot to be excited about, because for me, I am finally going to be able to release in a major way an indicator that I first developed really in 2010 with my third book, sort of introduced a concept of traders using historical volatility, how we've then turned it into really a spreadsheet process. And that spreadsheet process over the past almost 12 years has now morphed into an indicator that we can use across ETFs and futures and individual stocks. So super stoked to talk about time and volatility and how I'm day trading this environment. You can register over at simplertrading.com/price. All right, so let's get to it. Alan, how are you? When gold, let's jump on over to gold. So when gold gets up to fade territory, I'd like to buy gold puts. Yeah, so Alan, we're going to do the same thing that we've been doing in the mastery now for a couple weeks, which is being really patient. That's been necessary for gold. It's not in a downtrend anymore. It's really more of a fade. And then use those Darvis levels, starting at about 1868.5 and extending up to about 1877. That's the zone on GC that validates the MGC micro gold futures. That would be a short, or GLD puts. Heck, even keep an eye on GDX. There's a lot to like about the fact that as we see rates move higher, and even if inflation starts to or continues to tick higher, the real yield will continue to move higher, has been. And that's why we're seeing the movement lower finally on gold. But it's clearly not a great move lower because gold isn't in a downtrend, because real yields are not in a really great uptrend. But that's what I am looking at. And in the meanwhile, look, here's GC with the hourly price movement ranges on them. It doesn't matter when you're looking for opportunity, what time of day. If you're looking pre-market, heck, even this thing's going to warn you when to stay away for a little while because things are going to get ugly and choppy. And if you want to shorten the time frame, we'll be looking for buys in these areas. And then this is the stay away area right there. So until we get up there, think about the shorter term. Good stuff. All right, next up, please tell me about LQD. I'm looking at puts. Okay, cool. So looking at LQD, overall downtrend, looking at puts, I'm in complete agreement, Stephen. We need a rip. Yesterday in the Sector Secrets Mastery, we have our weekly macro market deep dive conversation. And a lot of the members are saying, Rag, when are we going to look for a short the rip? When can we get short? Because we've been in certain segments of the market, long dollar, also short euro, which is kind of the same trade. We're long yield, which is to say short bonds. That's been great. But when can we get short, get long some puts in these downtrends? And the answer was, I hear you, but at the bottom of a downtrend is not the time to short. It's when we get a rip. And that's why I'm very excited about what today's catalyst of Powell could mean. So same thing with LQD. I need a rip higher. And with that movement higher, Stephen, remember, bullish momentum is really an ideal environment to look to buy puts, not with lower lows. So that's what I'll be looking for. All right. Thanks for the question. Any thoughts on the FOMC prediction being over 90% for the 3/4 of a point hike, 75 basis point? So I use, and this is again when I was referring back to the video from yesterday. Look, gang, one of the things that I talk a lot about with you all, with the members in the futures room, most definitely my mastery folks, is I'm trying to take verbiage like I think, I feel. I'm trying to take that completely out of my thinking and out of my vocabulary. Because frankly, who cares, right? Who cares what we think? Who cares what we feel? Everything comes down to what do we see? And in terms of what we see, what is the trend of the data? What is the trend of price? Everything needs to come back down to what we see, right? So, for example, what I say my expectations are for the Federal Reserve comes back down to what I see happening on the Fed Fund futures, which is beautifully distilled. Shout out to the CME group for giving us an amazing countdown to FOMC free tool on their website. This is what gives us this is what I see And you mentioned 90%. Yeah, it's 97.9. It's 97.9. Here's where we are. Here is where we're expected to head. Now, this, which is the half point height column, would be a shock and would send equities higher. But this could still send equities higher because it's quote unquote fully discounted. Anything over 80 really has sort of a fully discounted type, expectation. So I'm always going to go back to this is where the data shows, right? Because I see too many people talk about bonds or dollar or crude oil or even the move in natty gas yesterday, right? A lot of folks ask me, Rog, does the move in natty gas to the downside or does the move in crude oil to the downside mean the Federal Reserve is, for example, less concerned about inflation? Oh my gosh, no, right? That's where thinking and feeling is going to get you into a lot of trouble. What did we see happen with natty gas? The 21-day expectation for the Freeport export terminal was pushed from 21 days to 90, right? Rate of change. We have the data, not our gut or our heart, right? Or whatever else doesn't have fingers and can't trade, right? So what happened? This was a huge update for the Freeport terminal closure. 90 days, and even at that, possibly a partial open, not even a complete open. Why would natty gas sell off on that? That means there's a bunch of supplies sitting in the U.S. and not leaving the U.S. Any conversation about increased supply is bearish to the underlying symbol. That's it. Does this undo the demand narrative? No. Is this a prolonged increased supply narrative? No. Do I expect natty gas to go higher? I expect that it's going to resume the trend that was preceding yesterday's volatility. So these are things where the data matters. The rate of change matters. And so, going back to your question there, I know it seems disconnected, but it's the same conversation, right? So this is how I make that decision. And I even hold my mastery members, I tell our sector think tank, I say, gang, if I ever start saying think and feel, and I'm not giving you the data that you can see as well, we're in tricky territory. We've wandered off into the tall grass. Keep that part of your process. It's going to keep you out of trouble, gang, because there's nothing worse than starting to sling trades based on what you feel. Been there, done that. We don't want to ever stay in that mindset. It is not a healthy one. It's not a helpful one, right? Okay, so moving on to crude. So relatedly, hey there, Brian, and thank you for the question, Azendi. Was there an indicator candle pattern that showed CLQ22 was going to sell off yesterday? So we're talking about the August. So you want to take a look at CLQ22. So the August delivery month. I'll tell you what, Brian, I don't look at the daily time frame as some major sell-off. That sell-off really existed on an intraday time frame. So the drama of yesterday's sell-off. By the way, what was yesterday's sell-off? It was based upon really some essentially some scuttlebutt about whether or not there was going to be any pre-tax on profits for oil companies, and whether or not there was going to be potentially a strategic petroleum reserve release. In other words, more supply, and then bad news for oil stocks. So the question is, was there anything that would have foreshadowed that? Well, I'm not looking for prediction, right? So foreshadowing, but to your point, was there visual signs of a rollover? Well, let's roll back. And this is why I love the indicators. There's no supposition here, gang. You can pull up and see what I see. We had a bullish environment that turned neutral. With the neutral, red grab candles, right? Once we got red grab candles, notice our HPMRs, that resistance started to step down. By the time we got to 2 p.m., volatility went berserk. That's the HPMR telling us by sandwiching and even crisscrossing, we are in extreme historical volatility environment. And in this case, with the red grab candles, to the downside, right? So I'm not going to say I knew this was coming. I didn't. If I did, I would have gotten us short. But were there signs of the shift in psychology? There you go, Brian. That's the way that I'll read it. That's the way I'll read it with my tools. And I think that's all we can do. We look at what's happening and we basically think about the counterpunch, right? We think about what kind of pitch is the market throwing our way and how do we react to that pitch. So that's the way it looked yesterday on my chart. So I hope that was helpful. And the movement lower, again, let's give it some context. I wish it was lower, because if it tagged the 21 propulsion, these green dots on my screen, we would have gotten long CL futures, micro CL, MCL futures, calls in the futures, or calls in USO. And what we did instead, because we did have sufficient pullbacks in a number of oil stocks, is we went the oil stock route. And by the way, oil stocks have been really steady, as have, frankly, natural gas stocks, despite the volatility in natty. So thanks for that question. All right, moving on. Martha asks, when I take a trade, when do I take a paper cut? What percent am I down to sell? Martha, for what I teach in the Sector Secrets Mastery, we do 3 types of time horizons, 3 types of time frames in that room. That room really is sort of my trading life, in the room. Short-term day trading, daily time frame, trend following, swing trading, and longer term investing. And each one of those has a slightly different tolerance for the point of validity. But generally speaking, it's 25%. So thanks for the question. Do I day trade on Fed days? Stanley, great question. Do I? So it's a caution day. It is absolutely a caution day. What's going to be in play in a major way? Dollar, euro, 10-year bonds, 30-year bonds, VIX, of course, the indices. I mean, basically everything, right? So I'll consider more conservative entries. I'll consider smaller position size. And I do tell new day traders, hey, if this is your first rodeo for a FOMC decision, maybe wait for the aftermath wicks that we can buy those puts into if we get that retracement that I alluded to earlier here in the show. And for my more seasoned traders, we'll start pulling up S&P, NASDAQ, XLK, XLY, and start looking at some of the range extremes. Today, we are very likely going to be operating outside normal operating temperatures. That's really not ideal, frankly, for any trader. Extremes that are apart from what we've seen. Think about what most indicators do. Most indicators are cumulative. They're looking at a certain number of periods back, and they're accumulating data and then spitting out some secret squiggle for us. So most indicators are cumulative, right? If all of a sudden we have something very unusual happen, that sudden expansion or contraction, in this case, it's likely going to be expansion, is going to throw those indicators off. And so that's one of the reasons I call these a caution day, because we're likely to see very unusual action. Well, where can we absorb best that really unusual action? Longer time frames. It's like having a bigger shock on your 4x4, right? If you're going to be traveling some rough terrain, you need some travel in your suspension, so to speak. The way we can do that with trading is we just go to the daily, where that sudden volatility shock that will be apparent on a 2-minute, 5-minute intraday chart can be very useful to close the distance to levels that we would like to act at. And so I will usually go to the daily and get opportunistic there. That's going to be a big part of the conversation of what I'll be doing when I go into the weekly Wednesday Sector Secrets Mastery live trading and Q&A here in just about a minute. But can you day trade as long as you're aware of the environment you're entering? Yes, it's fine. I mean, we've got the best tool that we could possibly use to handle volatility, right? And isn't it so funny? All of us traders talk about volatility, and yet there's really been no way to measure it historically. And I don't mean measuring it going back 7 or 14 periods. I mean measuring historical volatility. So I'll use this knowing that we're very likely going to be, especially the closer we get to 2 o'clock and after 2, we're going to be off road, right? We're going to be way off road in terms of that volatility. And that's where the clock, the day trading clock kicks in saying, well, we've got 9:30 to about 11:30. That is about the best window. And then we'll switch over to the daily and look for opportunity there. Okay. All right, gang. Awesome questions. Good stuff. And, if this is appealing to you, say, Rog, yeah, I kind of want to learn how to day trade this stuff. Join me tomorrow. I'll give you a really good, transparent sneak peek into what this indicator does, what my trading this year on the short-term time frames look like. And then you can decide for yourself. I want you to really be educated about what it is that this year is doing and what it is that this year's day trading really presents. So this way, if nothing else, you've got a really good idea of the proper mindset to carry through for the remainder of this year. And we'll be talking a lot about time and volatility. All right. So that's simplertrading.com/price. If you can't tell already, I am stoked. I am beyond stoked to finally be able to talk to you all about volatility in a way that we can see it mapped out on darn near any chart that we want. Okay, gang, be good to each other. I will see you tomorrow, same time, same station. And again, remember, gang, it's a caution day. All right. Position size accordingly. Be patient. And I'll talk with you soon.